Good afternoon, everyone, and welcome back to the Camarda Wealth Channel. I am your host, Troy Lerche, here with my coworker, Rick Dwyer, bringing you this week in wealth for the week ending May 28th, 2021. The past few weeks, I've talked about the CAPE indicator, and Rick's here to discuss a little bit more about what that is.
Yeah, so the CAPE indicator is a cyclically adjusted PE ratio. And what that is a 10-year period of following a specific PE ratio. So say tomorrow, we would go back 10 years and drop off the last day, and it just keeps adjusting every single day in 10-year increments.
Thank you. And what would normal be?
So a normal CAPE for the S&P is somewhere between 10 and 20. That would be kind of in the normal range. It can go below that, obviously, and can go slightly above that.
Okay. Where are we today?
37.5, I believe.
Oh, wow.
Yeah, a little higher.
Yeah, absolutely. So what does that mean, and when historically have we been this high?
So, we never really know what something means because you can see things get very high as we did in 2000. It was over 40 at that point. In fact, I think it was approaching 43. But when it gets high, like where it is today, when we look back over all the 10-year periods for the S&P 500, on the end of every one of them, the ending value was at a negative compared to where it started.
Okay. And how does Camarda use the CAPE in their methodology, or do they use it?
We do not use CAPE in our methodology, but like many other things that we look at, it is a data point that we are following.
Thank you very much. And when we talk about wealth management, we talk about the big picture over the last 120 years of secular bull markets and bear markets.
Yep.
Where are we at today?
Yeah, so the latest bull market started in March of 2009 after the financial crisis. We had a bit of a blip. I think that's probably an understatement in March of 2020 due to the pandemic. But that has not only been fully recovered, but new highs have been set since then. And so it's a continuation of the existing bull market that started in March of 2009. So we are in a cyclical bull market still.
Okay. And how do our indicators, I've talked about our indicators a couple of times. How are our indicators, have they changed at all from the previous week, or where are we at now?
No, all our indicators are green, which, as you know, means that we're fully invested, and until that changes, we'll remain so.
Thank you. Now we're going to go a little bit over the U.S. and international markets and some various news. U.S. markets ended the week up in the green. The Dow Jones was up 322 points for the week, and the tech-heavy NASDAQ finished up 2.1%. And by market cap, the S&P large cap rose 1.2%, while the mid cap S&P 400 and the Russell 2000 small cap finished up 1.4 and 2.4 respectively. With the international markets, the major international markets finished the week in the green. As grouped by Morgan Stanley Capital International, emerging markets rose 3.3%, while developed markets added 1%.
Yeah, we'll talk a little bit about commodities. Precious metals continued their climb. For the fourth week, gold rose about 1.5% to just over $1,905 an ounce, while silver finished up as well, 1.9% at $28.01 per ounce. Oil continued its consolidation from the highs that were set in March of this year. And for the May summary, we're looking at the U.S. markets were mixed for the month of May. As we discussed, the Dow average rose about 1.9%, while the NASDAQ actually gave up and had a loss of 4.4%, which led to a lot of the volatility we saw in May and a lot of that disruption that we saw in the tech-heavy NASDAQ. The large cap S&P 500, meanwhile, had a small gain of 0.5%.
Thank you. In U.S. economic news, the number of Americans applying for first-time home unemployment benefits fell to new pandemic lows, and the initial jobless claims sank by 38,000 to 406,000 for the week ending May 22nd. That was the fewest number of compensation claims since the onset of the pandemic nearly 15 months ago. Meanwhile, the number of people already collecting benefits, so-called continuing claims, fell by 96,000 to a seasonally adjusted 3.64 million, and that reading was reported on 1 week delay.
Yeah, since the jobless claims are going down and now the ongoing claims are going down, maybe we're going to start seeing the economy get its unemployment numbers lower and its employment numbers up again.
Yeah, absolutely. Home prices continued to accelerate in March, rising the fastest since 2005. Analytics firm S&P CoreLogic Case-Shiller reported the index of home prices across the 20 largest cities increased at an annual pace of 13.3% in March. And among the 20 cities, Phoenix saw the largest gain with 20% jump. Separately, the National Home Price Index, which measures home prices across the country, similarly rose a similar 13.2% over the past year, which was the highest annual gain since December of 2005.
Yeah, sales of new homes fell in April by nearly 6% as affordability constraints begin to weigh on home buyers. Despite the new lower reading, new home sales were still up 48% compared to the same time a year ago, which of course was probably had something to do with the pandemic. But one of the reasons that we're starting to see some of the slowdown in the new housing market is we're seeing a lot of pricing pressure. We talked about commodities with gold and silver earlier, but also lumber and building materials, concrete. A lot of those prices have skyrocketed over the course of the last year. And we're also seeing, not just a high demand for housing, but also because of rising material costs, that's also driving construction expenses substantially higher, like we just talked about. And between new home sales and existing home sales, a lot of buyers just don't have a place to go. They're getting priced out of the market due to the rising prices. 13% to 20% increases across the board could price a lot of people out of the market.
Yeah, absolutely. And then the another thing is, first time in 6 months, the confidence of American consumers slipped as they grew more worried about the rising cost of living and future job prospects. Economists had forecasted a reading of 119.5 in their consumer confidence survey, but all three major surveyors of consumer confidence declined in May, even as states loosened or eliminated the restrictions and opened up the economies again.
It's going to be interesting to see how that plays with the unemployment numbers as well.
Yes, absolutely. And a part of the survey asked how consumers feel about the economy right now, and that was a positive, surged again to 144.3 from 131.9, which is a new pandemic high. However, when asked about what the next 6 months looks like, it actually sank significantly to 99.1 from 107.9, which is a 3-month low.
Yeah, and I think a lot of this has to also do with the inflation concerns that we were just talking about, Troy. Again, last month, those fears jumped to a 13-year high, reflecting a broad surge in consumer prices in U.S. As the U.S. fully reopens for business. A separate measure of inflation that strips out food and energy also rose to its highest levels since 1992.
Wow.
Yeah.
That is orders and orders for goods expected to last at least 3 years, so-called durable goods, fell last month for the first time in a year. And the decline stemmed entirely from big drop in orders for new cars or trucks. And you actually, I mean, you know specifically what is going on with the car and truck market, right? I mean,
right. So you probably saw on the news that there's a chip shortage, and those auto manufacturers cannot build their vehicles without these chips. And so it's not that they don't have buyers; they have buyers. They're complaining they don't have vehicles, and they're not going to get them until the chip shortage gets straightened out.
That's amazing.
But what happens when we take those truck orders out?
Well, excluding transportation, new orders rose a healthy 1.1% in April, which is the best news in the report was the 2.3% increase in business investment.
Yeah, which we want to see, because if business is investing, that means they have a long-term positive outlook on the future.
Yes, absolutely.
So in some other international economic news, Canada's central bank is likely to cut its bond buying program again this year. In April, the Bank of Canada became the first major central bank to cut back on its pandemic-era money printing stimulus programs, and indicated it would begin raising its key interest rate from its current floor of 0.25% in the second half of this year.
And Rick, while you're talking about international news, British shoppers have hit the retailers en masse after shops are starting to reopen after another lockdown, following months of lockdown closures. Sales volumes have jumped 9.2% in April, which was twice what was forecasted. And the The central bank forecast this month that the economy would grow by 7.25% this year after slumping by nearly 10% last year, which is the biggest decline in more than 300 years.
Wow, that's a huge difference.
Yeah.
300 years, that's pretty significant. Well, in Asia, just days before the coronavirus shut down the city of Wuhan, the Trump administration and China both signed an agreement putting a temporary truce to their 18-month trade war battle that they had going on. The agreement didn't stop many of the same practices that sparked the trade war to begin with. And I think it's important to note that, but in return for signing that truce agreement, the tariffs that were put in place, that $360 billion a year in tariffs, remained in place. But what's interesting is that the European Union announced earlier this month that it was drafting legislation that would allow it to broadly penalize imports and investments from subsidized countries in China and elsewhere. So they're taking that blueprint that was laid out by the Trump administration and utilizing it as a framework to get things in place for the European Union.
Absolutely. And Japan's government slashed its overall economic view for the first time in 3 months from its economic report in May. And it was the downgrade was due to the impact of consumption and business conditions from the coronavirus state of emergency imposed in major areas of the country. And Rick, you're going to give us a little summary on the Fed, huh?
I am. Despite the Fed's insistence that, the interest, or not the interest, but the inflation fears are just transient or temporary, nothing to see here. Don't worry about it. The indications of widespread inflation are becoming so numerous as to be overwhelming. Deutsche Bank maintains a data series it calls the Inflation Data Surprise Index. And the current readings are the highest they've ever been in 20 years. And Deutsche Bank strategist Jim Reed described the last 10 data sets as almost off the chart. So I guess, Troy, we're going to have to look and keep watching inflation. And is it transient? Is it temporary? Or is this the beginning of something a little bit more severe? My name is Rick Dwyer. I want to thank you for joining me and Troy for our weekly update, and we look forward to speaking to you again next week. Have a great day.
Take care.